Welcome to the Stock Market Palantir. Today we are going to talk about Tempest AI Inc. Ticker is TEM.
And this company, it really presents one of the most fascinating and I would argue one of the most precarious investment cases we've seen this year. You've got this major fundamental turnaround happening, but it's happening against a market structure for the stock that is it's highly volatile, extremely shorted, and frankly fragile.
It absolutely is. I mean, the tension here is completely unavoidable. And I think the central question we have to tackle is this. Does Tempest AI's huge fundamental pivot, finally hitting positive adjusted EBITDA, does that definitively justify its pretty high valuation? And maybe more importantly, can that fundamental strength overcome all the structural risks from that short interest and all the off-exchange trading?
See, I come at this from a totally different perspective on how you balance those risks. I'll acknowledge it. The Q3 fundamentals for 2025 are, undeniably strong. Reaching profitability is a huge win. But when you really look under the hood at the structure, the extreme short concentration, the opacity of the trading, the optics of the insider selling, it just screams battleground stock. And in that kind of environment, I think the technical risks are so high that they really outweigh the certainty you get from the fundamentals, at least for now.
I understand that focus on risk, I do. But that perspective, to me, it kind of misses the forest for the trees. My stance is that TEM's financial results are the validation, the validation the market was waiting for. This company is finally proving its high-margin flywheel business model works. They're moving beyond being just another cash-burning biotech and becoming a true scalable AI platform.
Okay, that's a compelling narrative, but let's establish the foundation for that flywheel argument first. What exactly happened in Q3 that so fundamentally changes the story here?
Well, the narrative shift is undeniable because the numbers themselves are a complete 180. So look at Q3 2025, total revenue hit $334.2 million. That's a huge 84.7% jump year over year. But you have to look at the profitability inflection point. They hit $1.5 million in positive adjusted EBITDA. That's the key number, because it's such a stark reversal from the $21.8 million loss they posted the year before. In this market, crossing that profitability line is just massive, strategically. It opens them up to a whole new class of investor.
Okay, I absolutely acknowledge the massive improvement in adjusted EBITDA. It does signal that operational leverage is really starting to kick in. They've clearly managed their costs while pushing volume.
And the proof that this is sustainable is the margin expansion. The data confirms it. Gross profit grew 98.4% year over year. This is what confirms the flywheel is working. You collect data through diagnostics, which builds the asset, and then you license that asset for huge margins in the insights segment. And that high-margin data and insights business, licensing their 200-petabyte library, that's the engine driving this whole profitability boost.
And that is exactly what justifies the valuation, in your view.
Exactly. It's why TEM has a 15.4 times price-to-sales multiple. They're being valued on software economics because they're licensing data, not just, selling lab tests. If they were just a normal diagnostics lab, they'd trade at maybe 2 to 4 times sales. The market's giving them that AI premium because it believes in the data business.
I agree. That premium is all about the insight segment, but that reliance is exactly where the fragility starts. Before we get into that, though, let me finish building the case for just how perilous a structural environment is. Q3 strength is real, but the stock has these exceptionally high risk factors that you just have to price in, no matter how good the fundamentals look.
Okay, such as? Let's quantify these structural risks.
All right, let's start with the short position. The stock is heavily shorted. We're talking about 19.25% of the entire tradable float. I mean, that is an extremely high figure. And maybe even more critical is the days to cover, which is sitting around 4.4 days. So what that means is if a big positive catalyst hits, a new partnership or regulatory approval, the shorts will literally struggle to find shares to cover their positions. You're virtually guaranteeing a violent move up.
But that risk of a squeeze is also an opportunity for investors, right? That volatility cuts both ways.
It does, but the opacity baked into the trading really dampens the reliability of any of those moves.
we see an off-exchange short volume ratio of 57.15%. Let's just pause on that. Over half of the short volume is happening in dark pools, away from the public eye. This points to massive internalization by market makers. They create what are called synthetic shorts to hedge against retail option buying. And this structural opacity, it causes the stock's price to just disconnect from the news flow. Price discovery gets impaired.
But that's just trading mechanics. I mean, that's a reflection of the market, not a fundamental flaw in the Tempest AI business itself. The business is sound.
It might not be a flaw in the business, but it is a severe flaw in the investment vehicle. And on top of that, public shareholders are, well, they're structurally disenfranchised, which hurts conviction. They have a dual-class share structure, so insiders keep super voting control. That's a huge governance red flag. Add in the constant dilution risk from their evergreen incentive plan, and you have a whole set of constraints that temper the excitement from one good quarter.
Okay, I want to steer this back to the underlying business strength that generated that good quarter. Let's talk about the integrity of this profitability pivot. My position is that the massive growth in gross profit, that 98.4% jump, is structural and sustainable. It's not just temporary cost cutting.
And you're saying that's the flywheel effect. How does that translate into defensible profit margins, though?
Precisely. You have to see how the two segments work together. The company is growing its bedrock oncology diagnostics volume by a healthy 27% year over year. That volume is crucial because every test adds more unique patient data. That data asset is now 200 petabytes. That is an enormous barrier to entry. And at the same time, the high-margin insights business is contributing more and more. Because the data is already collected, the marginal cost of licensing it out just plummets as you scale. They are efficiently stealing market share from legacy labs, and that efficiency is what makes the margin sustainable.
I'm sorry, I just don't buy that the high margin is guaranteed to be sustainable, or at least predictable enough to justify a 15x sales multiple. We both agree the multiple hinges entirely on insights revenue, right? And that revenue stream is inherently lumpy. Let's look at Q3's $150 million in insights bookings. That is highly dependent on discretionary R&D budgets from biopharma.
They have diversified partners, though.
They do, but if we see a broad contraction in pharma spending, which is a real cyclical risk, those sales cycles for data licensing could stretch out. And that means future high-margin revenue is neither guaranteed nor predictable quarter to quarter. And that just rips the justification for the 15x multiple right out from under it.
But that kind of lumpiness is inherent in any enterprise software or data model. And they have cemented major partnerships, like the $200 million AstraZeneca collaboration. That validates the platform, and it helps smooth out some of that quarter-to-quarter volatility. It confirms long-term demand.
That collaboration is strong, yes. But if that high multiple revenue stream shrinks even slightly, the stock is immediately exposed to a sharp re-rating down to that 2 to 4 times lab multiple. And we can't ignore the operational risk from reimbursement hurdles for their new AI tests. I mean, management has explicitly said that can weigh on margins. The bull case requires near-perfect execution. It's just a very, very high bar.
I find that view overly pessimistic. Let's move on to another point that dominates the conversation: insider selling. My argument is that the big insider sales we saw in November, like the CEO Eric Lefkofsky selling about $12.6 million worth, are primarily noise. There are clear structural explanations for them.
But that's a significant amount of money leaving the table, especially from the CEO, right after a fantastic earnings report. I mean, regardless of the legal mechanics, it raises eyebrows. It impacts perception.
But we have to be precise here. The sales were done under prearranged Rule 10b5-1 plans. These were legally adopted back in March 2025, months before the Q3 beat was even finalized. These sales were essentially on autopilot. They weren't a reaction to the good news. And on top of that, other executive sales were just non-discretionary sell-to-cover transactions for taxes on their RSUs. This is routine stuff for founders and executives. It's not a crisis signal.
That's a crucial distinction, I agree, but I would frame the impact differently. I mean, regardless of the technical justification, the optics and the sheer scale of the sales, they just dampen retail confidence. They fuel all the negative narratives. And retail sentiment is crucial here. You need that buying pressure to fight the short position.
But are we really basing our thesis on Reddit chatter? I mean, these are psychological headwinds, not fundamental barriers.
Psychological headwinds are very real in a stock like this. They cap the upside. It's why the stock struggles to run even after genuinely good news. On public forums, these sales just amplify the pump and dump narrative, and that, coupled with institutional distribution, look at Bailey Gifford. They cut their holdings by almost 20% in Q3. It creates a powerful headwind of supply that just keeps the stock from breaking out.
But that institutional selling is being systematically absorbed by high-conviction buyers elsewhere. That provides a crucial floor for the price. ARK Invest, a very high-profile growth investor, is a confirmed net buyer. TEM is a top 10 position in their main RKK fund at a 5.1% weight. That accumulation signals real institutional confidence in the long-term AI thesis. It validates the premium valuation.
What we're seeing is a smart money divergence, not a consensus. ARK is buying, yes, but Bailey Gifford is selling. That's not a unified signal. And let's go back to the retail support you need to fight the shorts. The retail interest that was kicked off by the Pelosi effect early in 2025, it has significantly cooled off. It's gone from YOLO enthusiasm to just apathy and skepticism.
Long-term index inclusion will matter a whole lot more than day-to-day retail sentiment. If we stabilize above a $12 billion market cap, TEM gets set up for passive buying from giants like Vanguard and BlackRock. That's what ultimately validates the thesis, not meme chatter.
But in the here and now, that lack of enthusiastic retail support means the 19% short interest is much more likely to create selling pressure on the way down than a gamma squeeze on the way up. Sure, volatility is guaranteed, but the directional bias is highly susceptible to technical failures as long as this fragile structure exists. It's a tinderbox, but without the retail gasoline, the flame tends to go the short's way during corrections.
I still maintain that the long-term trajectory is clear, and it's validated by these financials. Tempest AI has crossed the profitability chasm. It's proven the viability of its high-margin data model. The structural headwinds you're pointing to are just temporary market mechanics, the predictable volatility of a high-growth stock in transition. And that volatility will eventually yield to fundamental outperformance, supported by institutions like ARK. The business model itself is fundamentally de-risked by that positive EBITDA milestone.
I just think investors need to proceed with extreme caution here. While the Q3 fundamentals are strong, TEMP is currently defined by a high-risk market structure, the combination of high short interest, dark pool opacity, and mixed institutional signals. It just makes this a dangerous battleground. The technical risk is profoundly elevated, and it will be until the market unequivocally accepts TEMP's AI valuation instead of treating it like a volatile, glorified diagnostics lab.
And the story of Tempest AI is fascinating because it forces us to hold two conflicting truths at the same time. You have this fundamental strength and operational success driving the intrinsic value, but you have this market structure fragility that's dictating the day-to-day price action. The sharp divergence between the two is what defines the entire investment landscape for this stock right now.
Exactly. And that divergence is why this story is far from over.
Thank you very much for hearing us. Let us know in the comments what is your opinion. And if you want us to analyze other stocks, don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.